And Southward Scalp Trader. We're joined here by several of our senior trading analysts, Brett Manning, Shark Trader, Scott Smith, Blue X, Gavin McGuire, Event Trader, and Jim Bush, Growth Trader, Setup X. So one of the reasons we wanted to have this webinar is we're getting reports and feedback of people sustaining some really heavy losses out there. And largely this is due to scaling into positions as they basically go into free fall. And that's worked pretty well for probably the past 6 or 7 months, but at least once or twice per year we get these type of conditions where you basically have to tap on the brake and scale back and recognize that market conditions are transitioning to another phase. So we wanted to make sure that I will kind of look at this as one of those situations where I wish I had someone to remind me of these conditions and how to work through these types of conditions over the years as I've been trading. And I have to admit, I've given up a lot of gains in periods like this where you go from making really good money and thinking that the trading conditions are going to stay this way for a longer period of time to all of a sudden things changing and the types of trades you were putting on for months and months not working anymore. So today we're going to go through basically the market conditions we're in, how we expect these to play out over the next several months, and basically how to position for the next phase of the market. All right, so for myself, one of the things I've been making sure to do making a conscious effort at is to reduce size and frequency of trades. So for example, I'm basically looking at the market and saying, hey, you have to make me trade today. I'm not coming in looking to put on a ton of trades. You're getting a lot of choppy action, very few breakout opportunities, and the real strong setup that you're seeing right now really is stocks that are bouncing into resistance and you being able to short those stocks. That is the cleanest setup I'm seeing. You're not seeing any breakouts unless it's to the downside. And so the trading conditions have changed dramatically right now. So when I look at my screen, I see very few names that I really want to participate in. A lot of them have gotten hit, especially the momentum names that we've made a lot of money on earlier this year. And the thing to recognize that's really important is that you have to start looking for that new crop of opportunities. If you keep trading the same old momentum names, you're probably going to get hurt. So, that is a really key element of transitioning in the current market environment, is looking for the next crop of names that you should be trading. Now, those aren't evident yet, so it requires a little patience to let those setups start to develop. So in terms of areas that I'm looking, I'm paying close attention to the IPO market. Recent IPOs that have come out and have priced weakly or priced relatively weakly or have gotten hit relatively hard, as well as earnings season. I'm going to be looking for new names to emerge that are showing compelling earnings growth that are possibly in sectors outside of what we've been making money in. So technology is going to be less of a priority, and for example, right now, oil field and fracking names are doing extremely well. Market loves those types of names. So, don't be afraid to start looking outside of technology, outside of biotech, and of course, the momentum themes. In first quarter, the marijuana stocks, for example, were really hot. A lot of opportunity there. Some of the smaller cap biotech names are really hot. I'm not sure what the next momentum theme is going to be, but I think you should really be on the lookout for those opportunities because you want the opportunity for the momentum players to get behind some of these names, shorts to start trying to chop them down, build up a lot of short interest, and get ready to participate in the second and third leg of the move, the price squeeze. And the last thing is patience and discipline are really the key here. You don't have to trade actively every day. Don't be afraid to sit back, look at your screen, and just watch things play out. To me, that's the really important thing. There are a lot of choppy trading conditions right now that can lead to ongoing losses on a daily basis, where stocks look like they're going to break out, but then they pull back into the range, and they basically give you head fakes all day long. So be willing to be patient, sit back, and let this market work its way through this period of dysfunction, if you want to call it that. There'll be opportunity to make plenty of money going forward. Just don't give it back right now. All right, so next up is Brett Manning, who's chart trader.
Yeah, hey guys, I just want to take a quick moment and run through some of the indicators I use to see kind of where we are in the phase of a corrective wave. Slide. Okay, the first off is probably the most popularly known or followed when you're watching kind of the life cycle of a corrective move, and that's the VIX. And one way that I would suggest seeing this, a lot of people see it as the fear index. I would suggest seeing it as basically the index of the kind of emotionality of demand for portfolio insurance by long-only equities funds, because that's the important side of it, and I'll explain what that really is about in a second. Odd lot short interest, another good thing to watch. Basically, it shows less experienced money, smaller traders, if you want to be on the other side of the market from those guys in a market that's changing trend or at least interrupting a trend. These are the way to spot them is odd lot short interest, and you can find this a few places around the internet if you look for it. For a couple of these, I use sentimenttrader.com, which is an easy aggregator. But this is basically, if you've got a small account and you're trying to profit because you think the market is going to go down, you think some of these high flyers have to come in. A lot of times, people start to do that as a crowd right at the end of a correction. When everybody decides, though, the bull market must be over, I'm going to make a fortune, by trading Google down 200 points. So inverse ETF assets and volume. Another pretty good tool here. You can see when money starts to suddenly, in an inflection point, pour in or crowd into the assets under management of an ETF that trades in the inverse direction of the broad market. And put-call ratio, again, similar basically to what the VIX is going to tell you in terms of how people are deciding to use hedges and the degree to which they're fighting for them. And the last point on this slide, basically, as a general guideline, corrective action will usually unfold. If you're talking about a corrective pullback or a shakeout in a bull market context, you're looking for second derivative extremes in these numbers. It's not an absolute number that the VIX gets to. Really, that doesn't matter. It's about a changing character of movement. It's creeping up, it's creeping up, it's creeping up, and then one day it just explodes, and you'll see it move 14% in 30 minutes. That's when you're at the really important point that I'm going to cover here next. Slide. Okay, when looking at the VIX, I would suggest that the wrong approach, though unfortunately probably the most common approach, is to see crazy spiking movement in the VIX as being a bad sign for stocks. That's really, I'm going to tell you, not the way to use it. Okay, when the VIX starts to really spike like crazy, that's the point where you've moved past the core portfolio distribution phase for a lot of these funds, and you move toward when they've basically sold what they want to sell, and they're trying to protect the rest against some catastrophe. The better way to look at the VIX is a really key indicator is when you see orderly, large-scale selling, but the VIX doesn't seem to respond. We had this a few days ago. I must have heard like 50 times on CNBC somebody saying the VIX is broken. We got a big down move in the market, and the VIX didn't move much, and everybody's like, wow, man, the VIX should be up a ton. The VIX is not really moving. The VIX must be broken. There must be too many other hedging instruments now that the VIX no longer applies. I've heard that about 20 times in the last 10 years. It's never correct. The reality is that means you got more selling to come, and that's what we saw. When the VIX starts spiking, you basically through the main wave of selling. But before that, when you see orderly, steady, large movement down and a VIX that's not really moving, that's the most insidious thing. That's the thing where you really need to just focus on nothing but shorting bounces. Okay, and again, that's because funds distribute what they don't want to own, and then they insure the rest of it. Slide. Okay, now just as a basic run-through for a lot of the other indicators that I'm looking at, I mean, if you look at put call right now, odd lot short interest, inverse ETFs, everything is pretty much middle ground. There's a little bit of spiking in odd lot short interest. Great example of when that really came through was after the first introduction of the concept of taper back in June of last year. You saw odd lot short interest go through the roof. That was dead at the bottom of that pullback in June. You're not seeing anything like that right now. The VIX doesn't seem to really be reacting a whole lot, though. It's got a little spiky this week. But again, we're in this kind of movement, kind of to echo some of what Damon was saying. the market right now, either this was just a shakeout in just a few select tech stocks and the Dow is going to be at new highs tomorrow, or in the context of this evolving corrective wave, there's still a few daggers to come. So, I mean, right now you do not see any extremes in the sorts of things you generally see extremes in that mark a capitulatory point in a market pullback. And finally, sentiment surveys, not at extremes of bearishness. We'll get a few more out later this week, and we may see some extremes in something like the AAII. But at this point, everything is middle ground. There's nothing that's extreme. We did have bullish extremes on a very broad time frames, very big time extremes back in December and January, and I think right now what we're basically seeing is the other end of that, the other side of that coin, where you saw a lot of exuberant new retail traders come into the market and a lot of stocks that they were basically watching but not buying for the last couple of years, and they're getting shaken out of them really hard right now. So, all right, that's all I got.
All right, thanks, Brett and Damon. I'm Scott Smith. I write under Blue Chip Trader on the site. Those are really good points that both these guys just made. I also want to emphasize, too, that since mid-March, I've been on the site repeatedly stating that you should be trading half size. The market was getting overextended to the upside. There wasn't much progress in the S&P and the Dow itself, and NASDAQ started pulling in a little bit more, along with small caps. And usually, that type of leadership was a sign that the momentum was slowing down. And we repeatedly said to be careful, trade smaller size, and that's one of the main ways that you're giving up profits that way, but it's also keeping you in the game and for the longer term and the longer haul. So that's like my main go-to methodology of risk management. So being a visually oriented person, I want to share some of the charts that I always reference to get a feel of the overall market tone and the biases. I do tend to show a lot of these charts on my swing trader column each week. I also reference them a lot under my blue chip trader comments on in play in all my recaps. These are just core basic indicators that I look at to just get an overall feel for the market. You can see on this first chart here, NASDAQ began underperforming the S&P. I'd say in the latter half of March. This is just basic moving averages and just tracking the relationship between the two. It's a ratio chart, a relative strength chart. And once this began to show an underperformance, it started suggesting that biotech, healthcare, internet, software, technology, all these sectors and groups that were extended to the upside on a weekly basis above their upper Bollinger Bands, RSI 14 where it was in overbought area, it suggested that you're going to start to possibly see some sort of massive correction in these stocks, and you either want to start locking in gains on the existing swing longs, or you want to start even looking at the short side, or possibly hedging yourself in a couple of these names. Another key chart that I always track is growth stocks versus value stocks, and growth stocks being the more riskier asset class, and value being a more defensive asset class. You can see that we had a nice run from last summer, trending higher up until mid-March again, and then all of a sudden growth stocks started to underperform, hinting that some sort of correction was in the works. Another great ratio chart to track would be cyclicals versus staples. Cyclicals are more consumer discretionary stocks where the retail or consumer is going to spend excess cash that they have on things like retail, autos, home improvements, casinos, hotels, restaurants. So that relationship was actually working really well for just about over a year, saying that the consumer was confident and strong. And then just recently, again, in mid-March, that started to underperform, suggesting that money was going more into staples, things like food and beverage and personal and household products. And you can just look at some of the charts of some staples like Johnson & Johnson, Procter & Gamble, even Budweiser and Coors and Kraft and Kellogg recently breaking out. Kimberly-Clark is right along multi-month highs, ready to break out to new high ground. These more defensive names, the market's just becoming a little bit more risk-averse or safety-seeking. These stocks all pay stable dividends. So you can just see that there's just more of this general tone of the market becoming much more defensive. once you have that established, that whole general idea of that the market's, not being as aggressive. You want to cut. This goes back to cutting back in your trading. You don't have to trade frequently. You don't have to trade every day. You want to also make sure you have half size. And try to give stocks a little bit more breathing room to, let these corrective patterns play out. And you also want to start looking for sector rotation. So this is where this graph here, this shows the 9 S&P sectors and their relative performance for each other over the for the month of April so far. And clearly you can see that utilities have been outperforming, energies have been outperforming, as well as consumer staples, while healthcare and financials have been underperforming. Now, if you dig a little deeper, those are general broad categories, but you can actually go and see which industries are actually doing much better than their peers. Among utilities, the top 5 performers are predominantly among the electric as opposed to gas and water. Amongst energy, there's a lot of oil and gas exploration and production stocks that are doing really well. I'm also starting to see some coal stocks jump into there, like PTU. Staples, it's kind of a broad category there, but mostly it's food-oriented. Basic materials, there are actually 2 packaging container stocks, BMS and MWV, which are actually looking really nice in the charts. We also have Cleveland Cliffs, or Cliff Natural, and Nucor, which are steel-related stocks that are, climbing up the right side of their charts. Among the industrials, we've seen Joy, Caterpillar, and Deere actually breaking out above multi-month basis. So again, you're seeing more of the flow into farming equipment and machinery. Amongst technology, it's mostly predominantly dominated by semiconductors. They've been really strong over the last month or so. They didn't participate in much of the March correction. So that's an area that you kind of want to start looking for, maybe on pullbacks, or try to find the stronger growth names or the fundamentally sound names in that group. Cyclicals. Most of these seem to be beating down retail that have outperformed here in the last week or so. I'm not really particularly a fan of that sector right now because of the shift that I'm seeing there. Financials, again, a weaker sector. Interestingly, the financials weakness seems to be mostly coming from the broker and the big money centers. But the REITs seem to be the ones that are really climbing up the right side of the chart here. They've been basing, they did not participate in much of the 2013 rally. They all pay really high dividends in the 3%, 4%, 5% range. And they're starting to just break out of these multi-month basis. So that's an area for financials to really take a closer look at. Healthcare. While biotech and major drug stocks have really taken a hit here the last couple of weeks, there actually has been money flowing into more of the medical equipment and lab research stocks. So over the last 6 weeks since March began, this is also just like a running total of where the performance is behaving. This is just a confirmation that the cyclicals are still underperforming, healthcare is still underperforming, and again, more money flow is rotating into energy, staples, utilities, and financials, which we have narrowed down to be more REIT-oriented. So these are going to be the laggard stocks. So if you're looking for shorting opportunities, most of these stocks have already broken down below the 50-day moving averages. In some cases, they're below the 200-day moving averages, or they're just they're so short-term oversold that they're starting to bounce off 200-day moving averages or 100-day moving averages. These are definitely going to be stocks and sectors that I'm going to start looking for swing shorting opportunities if they rally a little bit higher, whether they come into resistance at a 50-day moving average or a downtrend line off the March highs, or even if a stochastics or, say, an RSI gets into overbought territory, I'm going to start maybe focusing on reshorting them for swings as they are in a downward momentum. You can take all this information and you can keep narrowing it down to like specific, industry groups and stuff. This list here is actually on the liquid momentum focus list page, and it just basically focuses on the top performing sectors, and it kind of broke it down into each industry And again, you can see that semiconductors, medical devices, some aerospace names, utilities, the regional banks, real estate, transports, energy, food and beverage. These are all the leading sectors. You got to remember the S&P and the Dow are still above the 50-day moving averages. They're not that far off their recent highs. It's really the NASDAQ and the small caps that are really taking the brunt of the selling pressure. So these are more of the stronger sectors that I would be looking for more buying opportunities in. And that's basically, that sums up everything here. I definitely take a keep it simple approach to the market. You buy stronger stocks amongst the stronger sectors, and you focus on just basic technical analysis, buying breakouts, pullbacks to key MAs, moving averages, and support levels. And then you just look to short the weak stocks amongst the weaker sectors. Again, using just the basic technical analysis. Over the years, I've discovered that the hardest part in trading, it's not actually on the execution side. It's really just kind of finding out where, it's more about being in the right stocks and the right sectors at the right time. And I think if you just start looking at these ratios and these relative strength and relative weakness and identifying these strong and weak sectors, you can really narrow down your choices and put the odds in your favor, and then just execute the trade and manage the position from there. All right, so I'm going to pass it off to Gavin, who is event trader.
Hey, good afternoon, everybody. My name is Gavin McGuire. I post under the event ticker, Event Trader. Just going to provide some supplemental information to what the other guys on the team have already stated. Don't want to go over the same topics again for you, but just a couple of things that I wanted to point out. Number one is definitely try to avoid the headline risk that's out there in terms of reading too much into weaker economic data or tapering comments or even geopolitical. Obviously, it's been a big issue over the last 3 months, but always recall that the market's already pricing this information in. And generally, if you see a headline that is being explained as the reason for a move, it could be, there's a good chance that that's incorrect, whether or not it's a 6-month statement from Yellen or some news of Russian troops on the border of Ukraine. Avoid trading on that information. I mean, use it in your back pocket for trying to gauge market risk, but don't use that as the primary driver. We'll probably get a good example of that in about an hour or so when the FOMC minutes come down. But the real thing here is to realize that, the market is changing. Some of these recent momentum names over the last couple of months are pulling back, and now the key is to kind of find out where the winners are. For me, I'm really looking at Q1 earnings season as a potential catalyst for helping separate the winners from the losers. I think Scott Smith did a great job with providing you some names. So, there's some tickers that I'd certainly be watching as earnings season starts rolling out. We're basically in the early phases of it. We got Alcoa last night, not saying that that's bellwether anymore, but, it's the official kickoff. So we are getting into the full swing of things, and I think this is going to be one of the key drivers over the next couple of months. We are in pre-announcement season, so it's definitely important to keep an eye on who might be warning, who might be guiding higher, and kind of use that as an idea of what industries could be doing well. One thing to keep in mind with the pre-announcement is that when a company comes out and gives its earnings date and nothing else to go along with it, that generally means that, they're not planning on providing any stark warning at all. SunPower would be a primary example of this. That's good news for SPWR in that there is some concern over the solar names going into this earnings season. So that's something to keep in mind when you do see that company come out and provide its earnings date and, conference time. So basically what I'm looking at this earnings season is to try to see who the winners and the losers are, and then use that as a supplement for, what charts are looking the strongest or who's seeing momentum buying right now. We'll be providing plenty of coverage throughout the course of the season for that. And if there's any questions or any names that you have a particular interest in, please certainly send that into feedback. But we're going to be starting off with the banks over the next week and a half, and that's going to be a key industry to watch in terms of the overall economic health. So I'll be covering that in depth with some trading ideas, but the one thing I wanted to point out to keep in mind is the bank loan growth, which will provide a good read on the overall strength of the economy, and that could be something that helps settle down markets. The other thing that I'll be looking at closely is the reaction to earnings. I've been posted on Micron and Alcoa over the past few days, and I'm not trading on it just yet, but I am trying to get a read on how markets are reacting to certain earnings reports. So far, I characterize both of them as better than feared, and there was a decent initial reaction that got sold off relatively quickly. Alcoa is still holding its gains, but these are some things that you just want to kind of keep an eye on in the early going as more names start rolling out, and it'll also help provide you with an idea of what sectors are performing well out there and which could see further momentum and money move into the names. And I think this is going to be a good way to try to figure out who the new leaders of the market are going to be as we head into the second half of 2014 here. So this will be an ongoing subject of mine for the next couple of weeks. Like I said, if there's going to be any questions on it, please feel free to write in a feedback, and we'll try to keep you up to date. And like I said, use Scott's names that he provided as a good starting tool for this. And then as we go through, we'll try to pick the winners and the losers in terms of stock reaction and underlying fundamental performance. So I hope that's helpful. I'm going to be passing you on to Jim Bush here, and he's going to discuss the momentum names and GrowX names.
Hi, everyone. This is Jim. My section will be fairly brief since I know we're coming to the end of this. Essentially, what I'm going to be talking about is basically, for the last few months, I've really held off buying any of the declines in any of these high momentum growth stocks. My time frame is a little bit different. I like to hold things from, say, 6 months, 12 months, so it's more of an investing time frame. But what really clued me into that the market may have been in trouble was that while the major averages were hitting new highs in January and February, and the top names like Splunk and ServiceNow and the biotechs in particular were hitting new highs, there was increasingly erratic action in a lot of the smaller names, and particularly in new IPOs. So, for example, you might have the cloud or big data names, hitting new highs every week, but you might see some new IPOs in that group do really poorly. And that sort of clued me in that something wasn't quite right. For those of you who follow me, you'll probably notice that I haven't put on any trades in probably 2 months or so. And that's what concerned me the most. And then once you had clear signs of distribution in the leading growth names around mid-March, and you can define that as basically once these names started coming in and just completely failed to hold any of the key support levels like the 50-day or even the 100-day, they just kept slicing right through them. No buyers were stepping up. Once I started to see that, my goal just simply became to do no harm. Not try and catch these falling knives, not try and pick bottoms, but just let the dust settle and sort of see which new leaders take their place. And what I wanted to do today is just quickly go through a couple of names from the past that showed up on the emerging growth list, and just sort of show you what can happen with these, some of the biggest momentum names when they top out. So generally the sequence is, and this isn't always the case, but this is what you typically see. When the big names top out, they'll usually come in about 30 to 50% off their highs. Oftentimes you'll get people who missed the initial move. They've always wanted to own it, but it was always too extended for them. Then they'll jump in and say, wow, this is trading at 80 3 weeks ago. It's trading at 50 now. It's a steal, so I'm going to buy it. And then you get sort of a squeeze-driven rebound, and then they sort of chop sideways for a few months, or they just roll to fresh lows. And we see this movie sort of over and over again over the years. So if you're trying to buy the dip with these major names, you're sort of looking at sort of a best case scenario often where you have dead money for several months, because a lot of damage had been done to the charts. They need to consolidate. Once they sort of bottom, they'll spend several months just sort of consolidating, repairing that damage, and then they might make their way back up. That's sort of the best case scenario. And the worst case scenario is, if their move is done, they could do a round trip, roll over to new lows and just give up all the gains from the prior uptrend. So again, I went back to some of the biggest stocks from emerging growth over the years, just to give you some visual examples of this. So Riverbed was one of the biggest stocks of 2010. It peaked in early 2011. Had a really fast plunge, 30% off the highs, as this group, back then came under distribution, very similar to what we're seeing now. They did rally quite a bit. Riverbed went from, say, $30 back up to $40 over the course of several weeks or 2 months or so. But really, it's just kind of a big sideways chop, and then it just rolled over. So, the point of the Riverbed chart is just some leaders just simply don't come back. This was another of the big stocks from that same time period, iPGP. Some of you might remember that one from the GrowX list. That had a huge run from about $15 up to $75, topped out a little bit later than Riverbed. But this one actually got almost, the bounce in that one is almost imperceptible. It just kept going down and down and down, gave up half of its value. It has come back to its highs, but it's taken 4 years for that to happen. So, this is sort of an extreme example where, yes, the stock, a major momentum name did bottom, but it's taken a long, long time for this one to make its way back to highs. And best case scenario, this was sort of dead money for you if you're an investor. This stock actually looks really good now, which is why one of the reasons why I included it. This Sturm Ruger, this was from, it was one of the biggest movers in 2011, topped out in early 2012. Lost almost half of its value when it topped out. It did come back, but again, you have the same pattern where a lot of damage was done when it came under distribution, and it took about 1.5 years for that to sort of repair that damage and then convincingly break out afterwards. So Stamp is the same thing. So I just wanted to include that as just another example for you. And finally, this is a more recent one, Alliance Fiberoptic. This is a GrowX name that did really well on that list. Had a big run, but again, had a big plunge, bounced. A lot of people who had missed that first move sort of jumped in when it went from 22 down back into the teens. People got excited about it again, jumped in thinking they were getting a bargain, and then just rolled over to new lows. And it's sort of been, I guess you could say broadly trying to repair that damage ever since. So I just wanted to include some of these examples for those of you with a longer term time frame, that if it's a name that you've always liked that's getting chopped down and it's down 40% right now, don't necessarily think of it as sort of a bargain down here, because a lot of damage has been done to the chart, and just with these examples that I've given you, I could give you 20 more. It takes a long time to repair that damage. So you're better off, basically, what I would recommend is every couple of days I've been wiping my watch list clean. I just run a pure relative strength screen, just replace it, every couple of days, and that keeps my focus on which stocks are leading right now, and it removes the prior leaders from my view. So it's just kind of, it forces me to just take the former leaders off my screen and just focus on what's working now. And the other key point that I'll close with is that these rotational periods don't happen overnight. I mean, sure, we've had a lot of V-bottoms over the last 5 years or so, but when you come into a rotation like the one we're seeing now, we're in the initial phase of it. Last year's leaders are getting chopped down. You have new groups like energy and utilities that have sort of gone vertical in the last couple of weeks, but this is just the early stages. We're going to have a lot of back and forth. It's going to take some time for the dust to settle and for the new leaders to really prove that they have staying power. So my advice is simply take the time to learn about the new leading stocks rather than trying to pick bottoms in the past leaders. And again, this is from an investing time frame point of view. And that's really, those are my points, and I'll close with that. So I'll just turn back to Damon real quick.
Okay, so we hope this was helpful. If you have any questions, feel free to write us at briefingtrader@briefing.com, or you can reach us on the feedback to talk to us on InPlay. Okay, thank you.